How has the rally in gold and silver this year transformed the mining industry? Here to talk about the future of mining and his outlook is President and CEO of America's Gold and Silver, Darren Blasutti. Darren, it's such an honor to finally speak with you after all these months. We spoke last time in January at the Vancouver Resource Investment Conference. Welcome back to Kitco.
Great, thanks, almost, and good to see you.
Good to see you too, Darren. I like talking to you because you're always so modest. You always say, hey, look, I'm not great at predicting prices. That's not my business, but you've been pretty spot on every time I talk to you. Last time in January, you were saying that silver prices could surpass $23 an ounce before the end of the year. And sure enough, we've gone way past that. So that was absolutely the correct prediction. I want to know how the industry has changed relative to your expectations. Has everything gone according to what you have planned?
Well, again, I think we thought once people, accepted the gold price at where it was, and people got comfortable with that gold price, that the silver price would move. And we looked at gold being, $1,700-$1,800, and therefore silver being somewhere around that $23 mark. Obviously, we've seen the compression of the gold silver multiple come back from that 110 to 1 to kind of 70 again, which I think is more normalized. And I think that's something that we had hoped for and expected. But I think from an industry perspective, we've seen, market caps double and triple, especially for the explorers and the developers on the more of the bottom end that aren't producers yet. We've certainly seen their valuations come up. I think COVID has delayed the free cash flow that's going to start to get generated by the silver companies, because a lot of silver companies are obviously in Mexico and Peru, where there's been a lot where I think even more than the US, COVID has wreaked a lot of havoc on operations. So I think as we get through the COVID crisis through the rest of the year, and hopefully we don't see another, another second wave. But I think as that gets done and you start to see these operations be able to produce at full capacity for the quarter, I think you're going to start to see the silver guys starting to actually make free cash flow instead of constantly using ATMs to keep their balance sheet strong enough to be able to weather kind of the storm of low silver prices. I think we're going to start to see free cash flow added. And that's what's exciting and transformational about the industry. We've gone from being able to just barely being able to survive at, $15, $16 to now being able to thrive and being able to generate free cash flow. So I'm excited about that for our assets for sure.
So what does that mean for appetite for exploration? Are you seeing a lot more of that with higher prices now?
So I think for sure on the exploration phase, the big companies are certainly, they always lead the way with exploration. I know within our own company, our budget was relatively modest for 2020 outside of our Galena mine in Idaho. But I think we're going to see an exploration budget that's going to be 400 or 500 times higher for us than it was this year in 2020 for what we had planned, for sure. And I think throughout the industry, money's available again to be raised. And so those junior explorers who have basically been on care and maintenance are coming back in and starting to drill again. So,
Darren, at these higher prices, are you as a CEO see more leeway to increase your cost, all-in sustaining costs, or are you still going to maintain your usual fiscal discipline, if you will?
Well, I think one of the problems with what happened in the industry up till 2011 is a lot of projects got brought on that shouldn't have been brought on. And so rather than being smart with our capital allocation, we basically went all in and basically built everything we had in our inventory. I think we're going to use our same long-term silver price, which is $20 that we've used even when prices were lower. And we look at kind of investments and what we want to look at that price. I don't think we're going to change that to 25 or as silver's hit 27 today. I think we're going to be focused on long-term valuation and long-term value. And I think that's very important for the industry because, again, if we have excess capital, if we excess free cash flow, if we can't build projects at long-term prices, we should be giving it back to shareholders.
Right. And so under these conditions, how would you expect margins to change?
So again, I think when we talked last, we said, it's great that gold's gone from 15 to 17 or 8, or silver's gone from 15 to 17 to 18, but people are still losing money. So I think what's changing, what you're going to see over the next little bit is people are going to be making a little bit of money. And as you described, increasing their exploration budgets, growing the reserves and resources. So for example, this year, our Galena mine, we've gone from 80 million ounces to 130 million ounces across the silver mineralized inventory on reserves, M&I resources, and inferred resources, because we actually spent some money. And so I think you're not going to see, people, in the silver industry yet, giving money back as far as dividends, because we do have projects and we do have a lot of exploration we got to catch up on, because at $1,200 gold or $1,300 gold companies are making free cash flow and expending on exploration. Silver companies weren't.
Is it significantly easier now to raise capital, or is there not much of a difference than earlier in the year?
So I think earlier in the year, good companies could raise capital. They just couldn't raise very much of it. And I think what's happened now is good companies can raise a lot more capital. But I think there's still a hesitance to fund, back of the napkin stuff. And so I think the industry's in a good place. We just raised $39 million last week. We closed it. We were able to do that to get our Relief Canyon mine up into commercial production. And, we had a great institutional book, really large orders of really long-term good shareholders. So that tells me the interest is out there. And those, long gold funds has seen, Barrick's double and all these companies double, and they're starting to come down into the intermediate and junior space, which is important for us as we look for capital providers. So yes, I would agree. Yes, it has.
All right. So given prices now, and given what you just said about raising capital, what is your priority in terms of production? Are you prioritizing gold production more or silver production?
So I'm going to say precious metal production, because we've got a new gold mine coming on, and that's going to kind of dwarf the silver in the short term, because the gold mine is going to produce around 85,000 ounces a year. And so obviously at 70-1, that's a heck of a lot of silver production. But what we've been doing in the company, and what we talked about in January at the Vancouver conference, was that we've been keeping our high grade silver in the ground. And we've been keeping it in the ground because we were hoping for better silver prices to be able to deliver silver and into a very profitable period. And so I think what's changed for us is our Mexican asset, which produced a lot of lead and zinc and a small amount of silver. When that gets back up into production, we're going to focus much more on silver. So we're going to take silver from 500,000 ounces a year to 3 million ounces a year, because that silver can now be extracted at almost a $12 or $13 an ounce margin at these prices, as opposed to producing your best, highest grade silver when silver's at $15. So for us, the margin expansion as a result of high silver prices has changed our product and what we're going to produce. And even at Galena, we can now look at the silver copper, which is much higher grade silver, low grade copper versus low grade silver and high grade lead. So we're moving our product mix towards that silver. We want to grow our silver production from 1 million ounces to 5 million from the 2 existing mines we already have. And we can do that for very little capital. So that's our focus. And the new mine at Relief is very profitable. It's an $800 all sustaining cost mine when it gets up to full production. So whether gold's at 1,200 or 2,000, it's going to make gobs of cash, and we're excited about that.
Sorry, did you say your resource extraction ratio between gold and silver is 70-1? Is that what you just said?
No, I'm saying because the extraction ratio, the revenue ratio of 70 silver ounces for 1 gold ounce.
Okay.
Okay. Right now the new gold mine will kind of dwarf the revenue stream of silver. As we grow it from 1 million to 5 million, it will become kind of 60-40. So our precious metal stream next year would be 80% gold, 20% silver. And if you look out over the next 3 years, I think that number will be coming more like 60-40 gold, silver, as we expand the silver assets to bring that silver production back on that we've basically put on care and maintenance for, the last 5 or 6 years.
You're waiting on gold versus silver next year. Is this purely based on an operational strategy, or are you basing this on your personal sentiment on where prices are going for the metals?
Purely operational. Again,
okay.
We're using long-term prices of, $1,300 for our reserves in gold and $17 for silver. So again, all of the thought process around our revenue is based on that long-term correlation of 70-1, basically. And so as we go forward, what the beauty of our silver assets are, we can produce a lot of lead zinc and a little bit of silver, or we can produce a heck of a lot of silver. Again, going from 1 million to 5 million. Okay, but we're going to produce less lead and zinc with that. So the strategy is, where is the metal price? How can we make the most free cash flow? And what do we bring on? And again, because we've spent all the money over the last 6 or 7 years going from the high grade silver to the lower grade silver, it's easy to go back to the high grade silver. It's very capital efficient to do that. So our plan is, in our Mexican asset, to go from roughly 500,000 ounces in 2018 to about 2.5 to 3 million ounces in 2023. So it's a very big jump in that asset. So, and it's all around where silver prices are now versus where they were 6 months ago or 12 months ago, because we have confidence in the silver price.
Do you ever look at the gold silver ratio as a barometer for your strategy? Would you ever look at a high ratio, for example, of above 100, which is what we saw earlier in the year, and say, okay, well, gold's a little bit overpriced relative to silver, I should start producing more silver? Were you contrarian that way? So how would you interpret this ratio? Does it matter to you at all?
Doesn't matter. Again, it's about making the most money at the 3 individual assets versus a strategy between silver and gold. I mean, what I think was interesting is, if I go back, if I would have, we would have been buying silver assets in January, right, instead of gold assets, because you had higher gold prices and higher valuations in gold, then you had lower silver valuations. And so our San Felipe project that's in Sonora, Mexico, we just finished that deal with Hochschild. It was a better time to be buying silver assets because silver assets were very cheap. And so I think from a production strategy, it's about making cash flow. From an acquisition strategy, it's about what's the most undervalued, gold or silver.
Has COVID shifted your priorities at all this year?
Well, I think 2 things for COVID. Obviously, we are very focused on, I think our industry has done a particularly good job in the last 25 years of focusing on safety and trying to make our mines the safest they can be. And I think, structurally, our guys at site, our men and women at site, they're already wearing glasses, hard hats, they're wearing earplugs, they're wearing safety boots, they're wearing coveralls. So adding a piece of PE, I think, is a relatively easy transformation from that perspective. I think people understand the importance of it. I think from a safety perspective, it's not been that difficult. Whereas I think the modern mainstream of people around the world are focused against masks and not wearing them. I think from our perspective, we've always worn this equipment, and therefore I think it's a little easier. It's one more piece. But from a COVID perspective, I think it really shows you the difference between countries and where you operate. If you look at Canada, the United States, and Mexico, where we operate, I think Canada's done a very good job, dealing with the COVID crisis. I think the US as a major country could have done a lot better. And they didn't. And I think they're going to get around to it, and they'll fix it because they're one of the top nations in the world, and we'll get it right. And our people have embraced it, which is great because they've seen what happens. Mexico and Peru and those kind of places, it's very, very difficult. There's no government communication. There's nobody to pay if you can't work. There's, no doctors and medical, so our doctor in Mexico is seeing cases. We're the company's much more involved in the COVID strategy in Mexico, where there are no rules and regulations really around it, whereas we're following state laws and trying to be a bit better about them in the US or Canada. In Mexico, we've got to take a very direct, frontline stance on what the protocols are and how we make sure that we keep our guys safe.
Okay. So would you say that your developing regions operations have inherently more risk due to, especially in light of COVID? If an analyst or an investor were to say that he wants to assign a higher cost of capital to these developing regions, would you agree with that assessment at all?
Yes. I think in the short term, for the next year or two, as we find a vaccine, and again, the vaccine, is it going to take longer to get to rural people in Mexico and Peru and all these places? Absolutely, right? Nicaragua, wherever you're thinking about. So yes, I think for the next couple of years, there's a higher rate of risk in those areas than particularly they are in North America.
Does your company as a whole sell gold and silver at spot, or do you have forward contracts as well for hedging?
So we don't hedge gold or silver. We can hedge lead and zinc and the Mexican peso and diesel and those kind of things. But we don't, it's a company policy not to hedge gold or silver.
I'm curious as to why, because not all companies have this policy.
Well, again, so my background is I was a very senior guy at Barrick when the last time the gold price ran, and we had a $4 billion negative hedge book. And what I learned about that was when prices were low, we did very well and made a lot of money. And when prices were high, people are looking for the optionality to the metal. And if you've got it hedged, then there's no optionality. So, I mean, again, you've waited for 10 years of a terrible market in gold to actually see the gold prices rise and the silver prices rise. And then the company that you're investing in tells you, oh, sorry, you don't get the benefit of that because we've hedged, right? And so, again, we want to hedge all the things that are not related to gold and silver and lock those in to get low operating costs, but we always want to leave our revenue purely option free to be able to participate in those higher prices.
Yeah, and since you're not changing this tactic, I'm assuming that you feel optimistic about the metals going forward, the metals prices?
Well, and again, as I've said to you a number of times, I don't prognosticate metal prices.
You're good at it. You say you don't do it, but you're good at it.
So my view is we run everything at long-term prices. If we think we can make our cost of capital and we're going to have excess free cash flow, then we're not fussed. If we were building a project today and it required something to get to that return, then we'd think about it. But again, that's the comment I made about capital allocation and making sure that the industry itself is not building these really low margin projects, right? Just because prices are high this week. So my view is we won't need it. We've looked at things like lines of credit and capital, and given we've got a couple of new operations coming in, they've looked at these things and we've said no. And so that's our stance right now. Optionality is the most important feature of a precious metal company, and we're not going to change our view on that.
Okay, understood. Now, 49% of your share ownership is from retail investors, I last checked. 29% is from other institutional investors, and then you've got individual shareholders who are dominant in your share structure. Has this ownership structure changed at all this year, given the rally in prices?
Yeah, so I'd say that if you took the, Eric Sprott and Pierre Lassonde and Sandstorm, which are that big 22% block that we're missing here, if you take that out, I think we're about 50-50 after that institutional and retail now. So definitely been a move towards retail, towards institutional. As people have gotten more comfortable with the gold prices, right? And I think a lot of those retail investors have moved down the chain to more, earlier stage projects, right?
Was that intentional? Were you trying to attract more institutional investment this year?
We want every investor, whether they're retail or institutional. We're happy to deal with everyone. Our view is to create the best environment for people to invest in. Institutional shareholders are obviously, it's easier when you only have to talk to 3 people or 5 people after your quarter instead of 3,000 people. But ultimately, we try and set up our website, and we've got Andrea and we've got Stefan here to try and do as much retail as we can. The unfortunate part about retail is we did a lot of these conferences that were retail based, and given COVID, it's been a little bit more difficult to get your message out, right? So stuff like precious metals and getting the speeches up on the websites, I think, are important for retail investors to be able to have contact with the companies.
Okay. Finally, Darren, you have a plan to increase precious metals production by 500% by 2021. Can you walk us through your latest projects and how you plan to achieve that in the next year or so?
Well, the first thing is getting to commercial and then full production on Relief Canyon. That drives, not 80% of that increase, right? So from year to year. So, that mine started to produce gold at the end of February on a very small scale. We expected kind of towards the end of the second quarter to be in commercial production. Given COVID and a few startup challenges, that's now moved to the mid fourth quarter kind of timing. And that's why we need to raise a little more money. But we're very confident that's going to come in. We just put out a press release talking about the project and how it's leaching better. And just to really kind of the Coles Notes version for Canadians, or the very quick update there. We basically had 20,000 ounces on the top of the deposit of 650,000 that were the old pits. And it turned out those ounces had really high grade silver in them, which is normally a good thing, except that silver doesn't leach quite as well as gold when it encapsulates the gold. So we weren't getting the recovery out of that low grade gold because there was too much silver. So that kind of slowed the commercial production project down. As of August, we got to the lower part of the pit, and the mine's going like gangbusters now. So again, I think we expect to be in, breaking even by the end of October and in commercial production early in the in that fourth quarter period.
Okay, well, congratulations, Darren, and I hope you have continued success. Thank you for coming on Kitco today.
Great, thanks, David. Appreciate it.
And thank you for watching Kitco News. We'll have more for you at the coverage of the Precious Metals Summit. I'm David Lynn. Stay tuned.